income team. It's been pretty wild in your guys' markets. What are you seeing?
Well, let's first address the elephant in the room. Fitch downgraded the U.S. Debt this week. We think that's a tempest in a teapot, although the factors they stated are real and they're long-term concerns. The dollar is still the world's reserve currency, but 10 years of highly partisan government has real-world ramifications. In terms of the municipal market, Fitch said it will potentially downgrade pre-refunded bonds, student loan bonds, and housing bonds because of the government participation in those markets. We don't think that's a big deal because nobody's been paying for the re-rating of pre-res for a number of years now, and we don't own student loans and we don't own housing bonds. So that's not a big deal for us. The street has been changing its tune really from an imminent recession being just around the corner to a soft landing. Sweta and I, back in November, thought we could build a bull case for bonds and a bear case for bonds with equal conviction. So therefore, we moved our duration targets to neutral and have been that way for most of 2023. Inflation, which is, the boogeyman of the fixed income markets, has been declining. Core CPI and core PCE, the Fed's favorite inflation measure, has rolled over, but they both remain stubbornly above 4%. The Fed's target is 2%, so they still have a lot of work to do. Core CPI came in at 4.8% and core PCE came in at 4.1%. But today we've had some good news on the inflation front. Non-farm productivity came in much higher, 3.7%. versus 2.2% expected. And that bled into unit labor costs, which are now came in at 1.6%, which was below expectations of 2.5%. The Fed increased short-term rates last month. No big surprise. They did it by 25 basis points. The market's currently forecasting a probability of an increase in rates in September and November of 17 and 19%. The economy is proving very resilient. Second quarter GDP came in at 2.4%, and Bloomberg estimated that the expectations were 1.8%. The economy is doing great. Unemployment's running at 3.6%. The JOLTS survey came down. Job openings were down. Job openings were down from the 10 million plus range to 9.6 million, but that still means there's 1.6 jobs opening out there for everyone looking for a job. Tomorrow's job reports, I think, will be market moving. As I said, the economy is resilient. Milton Friedman once said that inflation is a monetary event. Everybody's talking about the monetary aggregates rolling over. M2 has rolled over. It's been decreasing month over month. But there's still a heck of a lot of cash in the system. If you were to look at the amount of M2 outstanding, it's a 3.5 standard deviation going back to 1959. And at the same time, what we're seeing is that the velocity of money, how much it turns over, is beginning to pick up. And you need both to cause inflation. And that is before the Biden spending plans kick in, the infrastructure program. So we still think the economy is going to be on solid footing going forward. In the municipal market, we are at a seasonally high period in August, and we expect that to, in terms of valuations, we expect that to resolve itself in September. Current AAA general obligation ratios are a little better than break even. So, but we had 12 billion of supply come to market this week, so the dealers were getting a little nervous, especially considering that in both the taxable and tax exempt markets, we're up about 25 basis points over the last week, up in yield. So they priced their deals with extra spread to compensate investors, and we have been buying. We think this is a buying opportunity. So it appears that the Fed is close to the end of its tightening cycle. Money market rates are very attractive at this point in time, somewhere over 5%. But that could change. Okay. And what happens when it does? So having spent much of my youth playing pool and invoking the spirit of Fast Eddie Felsen, I would ask you, what is your leave? How are you going to hedge yourself against the ultimate reduction in short rates and a decrease in yields on money market funds? One of the measures that people use is the spread between 10-year treasuries and 2-year treasuries. The curve is inverted, and at the end of June, that spread was minus 1.06%. The end of July, that spread was minus 92 basis points. Today, only 4 days later, that spread is minus 71 basis points. So what we're seeing is an event called a bear steepener. Short rates kind of staying where they are and long rates going up. That's good. So the question I leave you, and that Sweta will answer, how are investors going to avoid the cash trap? Sweta, I give it to you.
Thanks, Chris. So what Chris is referring to, the cash trap, is the short end of the curve, right? It has both for treasuries and municipals have looked so attractive for the last 6 to 12 months. And it makes sense that investors have piled on to the short end of the curve. If you're getting a 5% handle to invest in shorter treasuries and money market funds, why not? That makes a lot of sense. But remember that old adage, what goes up must come down. So this is what happened in January of 2001, when Fed funds rate were around 5.98%. And within 9 months, October of that year came down to 2.98%, so 58% drop. What we are not saying is that Fed funds rate is going to come down anytime this year. But what we are talking about or pointing to an underlying risk here, which is that the very short-term nature of money market funds. Money market funds have a maturity of somewhere around 28 days. So that's when you know you're getting that 5% yield. So how do you extend your duration? You hedge against this reinvestment risk and give yourself a sustainable dividend stream. So what we are proposing is take your money market fund and add a longer term bond component, maybe 15 months, maybe 18 months. We're partial to an 18-month actively laddered bond strategy alongside with your money market fund. So what that does is gives you the ultimate luxury, which is the benefit of time. Remember the flow of money into money market fund? What happens when all of that money exits? Whatever the next opportunity that this money is chasing becomes very expensive. So perhaps what Chris and I internally think is a more thoughtful way to protect your dividend stream would be extend duration, give yourself that time, is a combination of an active bond portfolio with the money market fund, probably say a 90-10. Without getting into the weeds with numbers, it comes about the same, but it gives you the hedge and the protection against interest rate volatility.
Awesome. Thank you, Sweta. It's been easy to make a lot of money in money markets or treasuries at the short end for a period. Maybe that's starting to change, and financial advisors and their clients need to be thinking about that, is what you're saying.
Yes.
Okay, great. With that, let me turn it over to Michelle to answer any questions. I do want to point out we really pride ourselves on transparency and accessibility here at City Different. So if you're feeling shy and have questions for the team, reach out to any of us. We want to be in touch with and build long-term partnerships with our clients and customers. So never hesitate to reach out and talk to any of the team members about anything that's on your mind. But Michelle, go ahead.
Yep. We had a question come in, Chris and Sweta, why have rates moved so much so far in August?
Well, I think it's because when we went into the debt ceiling kerfluffle earlier in the year, the Treasury reduced its cash holdings to keep the government funded and operating. And now they have to rebuild that. And not only that, they're thinking about, gee, the congressional clown show is coming back to Washington after summer vacation. And we may have, they may shut the government down again. And so let's build up our reserves to have enough cash on hand that we can keep the government funded. Now, I've seen Treasury bill estimates of anywhere from 5 billion to 55 billion. And they're also coming up to a big debt refunding next week, excuse me. So I think all that pressure has caused rates to move higher. I don't think, and let me be firm about this, I don't think it's because of the Fitch downgrade. Even though
Sweta, do you have anything to add?
Yeah, I was just going to jump into everything Chris said. And in addition to that, remember that the Federal Reserve is actively shrinking its balance sheet. Also, the debt service cost. So we talked about treasuries, how, juicy yields of 5%. But remember what that does on the back end for debt service payment. Now that shoots up and you're looking at a bigger federal deficit for which the Treasury has to issue more Treasury bonds. So what we are seeing this week and next week is a deluge of Treasury issuance coming into market.
Thank you.